Ever wondered what those lines and numbers in healthcare financial statements mean? Or why do non-profit and for-profit healthcare systems present different figures? Today, we'll tackle these questions head-on. First, let's break down the trio of financial statements: the income statement, the balance sheet, and the statement of cash flows. These are not just dull documents filled with numbers. They're the pulse of an organization, providing a health check on its financial condition. First on our list is the income statement. Think of it as the EKG of a healthcare organization, showing its profitability heartbeat. The income statement or statement of activities illustrates the organization's revenues and expenses over a specific period. It's like a financial storybook, narrating how the organization earned and spent its money. Key terms to remember are net patient revenue, operating income, and non-operating income. Net patient revenue refers to the income from patient services after factoring in discounts and allowances. Operating income is the profit after subtracting operating expenses from the net patient revenue, while non-operating income covers revenues and expenses not related to the primary activities of the organization. Now, let's talk about revenue sources. For-profit healthcare organizations mainly rely on patient services, while non-profits also include donations and funding. Understanding the income statement is like reading an EKG. It tells you about the organization's profitability and operational efficiency. Next, we have the balance sheet or statement of financial position, the X-ray of a healthcare organization's financial health. This financial snapshot is a list, a catalog if you will, of a healthcare organization's assets, liabilities, and net assets or equity. You may think of assets as the resources that keep the organization running, while liabilities are the obligations it must meet. The difference between assets and liabilities gives us the owner's equity or net assets. Now, for-profit healthcare organizations focus on shareholders' equity, which represents the residual interest in the hospital's assets after deducting liabilities. In contrast, non-profit organizations report unrestricted and restricted net assets, reflecting the resources they have at their disposal for achieving their mission. You'll come across terms like current assets, long-term liabilities, and retained earnings. Current assets are like the organization's ready cash, while long-term liabilities are debts due over an extended period. Retained earnings simply represent the net income that's been reinvested in the organization. Much like an X-ray, a balance sheet provides a clear picture of the organization's financial health. Finally, we have the statement of cash flows. Consider it the metabolic panel of a healthcare organization, tracking where the cash comes from and where it goes. This report is neatly divided into three main sections: operating, investing, and financing activities. The operating activities section is the heartbeat, revealing how much cash the organization generates from its primary healthcare services. Investing activities, on the other hand, track cash used or obtained from buying and selling assets, such as medical equipment or property. Lastly, financing activities show how the organization raises and repays capital, perhaps through loans or issuing shares. Why is this statement so essential, you ask? Well, it provides an unfiltered look into the organization's ability to sustain operations and invest in growth. It's like a financial stethoscope, listening to the subtle rhythms of cash flow. Just as a metabolic panel reveals a body's energy use, the statement of cash flows shows how an organization generates and spends cash. So, financial statements are not just sheets of paper with numbers, they're the pulse of an organization, providing a health check on its financial condition.